Today, we're going to talk about taxation of life insurance. One of the nice things about this country, basically, is that if you don't want to pay any taxes and everything else, then essentially don't earn any income, and then you're fine, okay? But the reality is all of us obviously want to make an income. Not only do we want to make an income, we also want to invest the money. And so by investing the money, what happens hopefully is we're going to get some kind of a return over and above whatever we've invested. And so therefore this formula is very, very important, because here in Canada, what happens is you're not taxed on everything. You're only taxed on the policy gain. And so what is that definition of that policy gain? And the definition is really quite simple. It is the proceeds of disposition. In other words, what did you sell the stuff for, basically, and minus the adjusted cost base, okay? The adjusted cost base being what did you pay for it, basically. So if you bought something and then you sold it, if there was a gain, then you have to pay tax. So if, for example, you bought a GIC, 5-year GIC, and you paid $1,000, and then at the end of the 5 years you got $1,200 out of it. That $200 obviously is going to be your gain, and you're going to have to pay tax on that particular gain. So the gain is the part that we have to worry about when it comes to taxation. We do not have to worry about the adjusted cost base, because what the definition of adjusted cost basis is essentially is what did it cost me to buy this? You know, what was the purchase price? So the adjusted cost basis is really the cost of purchasing the item. So for example, let's say you bought a cottage, $100,000, and a number of years later you sold that cottage for $500,000. You're going to get that $100,000 back tax-free. So in other words, the adjusted cost basis is really a return of your own money. So therefore, there'll be no taxation on that particular money. But you will have to pay tax on that gain. So going back to the example, you bought it for $100,000, you sold it for $500,000, you have a $400,000 capital gain. There's going to be taxation on that particular capital gain. Okay. Same thing with that GIC. You had $1,000. And 5 years later, you have $1,200 out of it. That $200 will be taxed. $1,000, of course, is your adjusted cost base. Now, I draw your attention to the word basis and base. Okay, base is used. You'll see this adjusted cost base. This base is generally used for what we call capital properties, so stocks, bonds, properties like a cottage. We use the word base. Okay, but for insurance, because it's not considered capital property, we use the word basis. So on the exam or material that you're going to read, you'll see the word basis. So it's not a typo, basically. It is to make a difference between capital property, you might say, and non-capital property. So we use the word basis. So how to remember that is IS, basically insurance. That will give you an idea. So the adjusted cost base is really, what did it cost me to buy this life insurance policy? What was it? And we'll look at that in a moment. But another very, very important concept as far as insurance is concerned is what we refer to as last acquired date. And so once again, in the material that you read, you may see the word purchase, but you may also see it more and more. You might see the word or phrase last acquired. What does last acquired means? Okay, remember that you can buy a life insurance policy once, because you purchase an insurance policy once, but you can last acquire it a number of times, and that's the distinction. Okay, is that when did I actually acquire it? So you'll always see material will always refer to the purchase of a policy, not so much the word purchase as you'll see the word last acquired. So let's go through things that affect that last acquired. Obviously, when the policy was purchased, that was the last acquired. If you never changed anything at all, okay, that is your last acquired date, was the actual purchase date. However, what if you changed ownership? So now I've transferred. So I acquired it at a certain time, and then I transferred that policy to somebody else on an absolute basis, whatever it is. Well, that somebody else, that new owner of that policy, last acquired it now at that particular date. So let's say I purchased it in 1990, and I absolutely transferred it over to whatever, a new owner or whatever in 1995. Then the last acquired date is 1995. So it's the exact same policy, but the last acquired date is the key element, and you'll see why last acquired is very important when we talk about taxation in a moment. Okay? So change of ownership can change the last acquired date. the change of coverage can also change. So a few years down the line, you increase your coverage or you decrease your coverage, whatever it is. Once again, it will be at last acquired as of the date of that the change in that coverage. And the policy lapses. So you purchased the policy, let's say in 1980, you lapsed it in 1985, you reinstated it in 1986. Because as you know, you can reinstate a policy within 2 years of the lapse date. So you reinstated in 1986. So now you've last acquired the policy in 1986, you see. So even though you purchased it in 1980, but you last acquired it in 1986. Why we do all of this is the question of grandfathering. In other words, if you purchase that policy before a certain date, and that certain date, a very important date to remember in the insurance industry, is December 2nd, 1982. In other words, policies that were last acquired prior to December 2nd, 82 are grandfathered. Okay, in other words, they fall under a different taxation regime, basically. Policies that were issued last acquired December 1st, 82, in other words, after December 1st, 1982, will fall under the new rules, which again we'll look at in a moment. So that last acquired date is very important because let's say that you did purchase the policy, let's say in 1979, for example, and then the policy lapsed in 1985, which is, of course, after 1982, okay, and now you restate in 1986, you've lost the grandfathering. So the whole idea of last acquired is to try to maintain the grandfathering aspect of it because policies that were issued prior to December 2nd, 82 are more tax favored, as you'll see very shortly. Policies that were issued after December 1st, 82 are not as tax favored. So it's a very important division, basically, in the taxation of insurance policies, and primarily for universal life, because as you know, there's dump-ins, and you can invest substantial sums of money, and so therefore it really more applies to universal life, but any permanent insurance will follow the same same rules and everything. So let's take a look at the impact the last acquired has on taxation. I mentioned that policies issued prior to December 2nd, 82 were more tax favored. Well, how's that so? Well, it's really quite simple because what happens is it all depends on the adjusted cost base. In other words, the formula for the adjusted cost base has changed. So prior to December 2nd, 82, there's a certain formula, and post December 1st, 82, okay, is a different formula altogether, okay? So let's take a look at the prior one first. So the adjusted cost base for non-participating policy, okay, was simply the premium. That's it. Simple as that. So you gave me $2,000 a year for 10 years. Your adjusted cost base is $20,000. Simple as that. Okay. So you receive a statement from your insurance company that says you got $50,000 sitting in there, but your ACB, your adjusted cost basis, is $20,000 because that's the premiums that you paid. Then the taxation is only between the $20,000 and the $50,000, and that's it, basically, okay? Because remember, I said to you earlier that the ACB is tax-free, okay? So your ACB is a return of your own money, so therefore you're not going to pay tax on that, but you will pay tax on the gain. So our $20,000 is your base, that's the cost base. Proceeds are $50,000. That $30,000 will be considered essentially T5 money or interest money, basically. For the participating policy, slightly different, okay? We always start with premium. So we'll go back to the example, $20,000 that you paid me over 10 years. But during that period of 10 years, I also refunded back to you a dividend of some sort. Okay, so that refund of that dividend, remember, is basically a refund of your premium. And so therefore, even though, yes, we acknowledge the fact that you gave us $20,000, but let's say we gave you back $2,000 in dividends during that same 10-year period of time, okay, then really what happens is that you didn't really give us $20,000 because we gave you back $2,000. So therefore, the adjusted cost base will be $18,000. So now the difference between the $18,000 and that $50,000 will be taxed as interest income. So moral of the story basically is that on participating policies, dividends payout reduce your ACB. Remember, the objective here is a higher ACB obviously will be less tax. The lower your ACB, there'll be more tax for the same disposition. Okay, so in the non-par, because there were no dividends, the taxation, that's the difference in the 20 and the 50. So that's basically 30,000. Now, because we did give you back a dividend, the taxation, because that ACB is lower to 18, then it'll be $32,000, because it'll be the difference between the 18 and the 50, and therefore you have a much higher tax liability, basically, because of that disposition is that much higher. Okay, so that's fine. So those are policies that were issued prior to December 2nd, 82. And unless they are impacted by any of these things here, these are grandfathered. Okay, so these policies will be grandfathered forever and a day. But keep in mind that if there's a change of ownership, change of coverage, or the policy lapsed, whatever it is, then it lost their grandfathering and you have to start all over again, basically. So what is that? So post 82 is so that policy is last acquired after December 1st, 1982. So basically from, might say 11:59, December 1st, whatever it is, falls under the old rules, and 12 o'clock, December 2nd, 82, falls under the new rules. So the big change, once again, in non-participating is premium again. We always start with premium. Minus NCPI. And NCPI is net cost of pure insurance. Net cost of pure insurance. Right? So now what happens is, yes, you gave us $20,000, but during that same period of time, we had to insure you. And it cost us, let's say, $2,000, let's say, to insure you during that same period of time. So you benefited from that particular $2,000. Had you died, we would have had to pay out, let's say, $500,000. So we had to buy insurance on your life. So you received the benefit for that $500,000. You received the benefit. And that $20,000 that you paid, we gave you back, let's say, $2,000 worth of insurance premium to buy the $500,000 of coverage. And so therefore, the NCPI will be reduced. I'll give you an example. For any of you that are golfers, if you've ever gone to a golf game, a charitable golf game, and you paid out $250, let's say, to play the game, but you only received a receipt for $150, and that's it. So you all say, well, I gave you $250, how come I'm only going to get a charitable receipt for $150? And the argument that will be presented to you is, yeah, but you did play the game. Yes, I did. And you did have dinner. Yes, I did. And you did drink the beer. Yes, I did. In other words, you benefited at a rate of $100. So therefore, the only part that the charity really got was $150. You see, so for the benefit here. So it's the same idea here. The NCPI is you actually benefited, because had you died, we would have to pay out $500,000. And so therefore, we need to reduce your adjusted cost base by the net cost of pure insurance. So moral of the story basically is that, once again, what we're having here is that the NCPI reduces your ACB. So I go back to the example here. I said to you, you gave us $2,000. The gain was $50. Now you only have a $30,000 gain. This post 82, same situation, $20,000. Okay. However, we did have to insure you during that time. So now we have the NCPI, and so therefore the taxation will be that much higher, because you gave us $20,000. We paid out $2,000 to insure you during that time. So therefore your ACB is really only $18,000. So once again, 18 to 50, you have to pay tax on that much more, basically. Okay. In a participating policy, the par policy, once again, premium, like I said, we always start with premium, okay, minus the NCPI, just like we did here, because we still have to insure you, okay, we still have to insure you, minus, again, your dividends. Okay, so the real difference between pre and post 82 basically is that pre had no NCPI, no net cost of pure insurance, okay? And post, there is a net cost of pure insurance. So once, very important for you, if you're reading the material or you're writing the exam or whatever it is, to keep in mind, when was this policy acquired? If it's last acquired after December 1st, 1982, you have an NCPI issue. If it was last acquired prior to 1982, then you have no NCPI issue. So that is an important distinction between pre and post, and all the reasons why a policy in actual fact could lose its grandfathering. And we'll see you next time.